Welcome to the Deep Dive Library, your go-to place for real talks on entrepreneurship, finance, and personal growth. No fluff, just bold insights to help you grow, build, and lead. Let's dive into the question: how do you manage business cash flow effectively?
Ooh, that's a big one, a really big one. It's probably the most critical aspect for survival that so many business owners, especially early on, maybe don't grasp the full weight of.
Right, until it's almost too late, maybe. You hear the horror stories.
Exactly, because we're not talking about profit on paper here. We're talking about the actual tangible cash moving in and out. You know, can you make payroll?
Yeah, can you pay your suppliers? Can you keep the lights on, literally?
That's it. That's cash flow in a nutshell. It's the operational reality.
I like the analogy I've heard thinking of it as the business's bloodstream.
That's a perfect analogy. When it's flowing freely, everything works, the body is healthy.
But if there's a blockage,
a slowdown,
and you feel it immediately,
Yeah.
Stress levels shoot up, you're making tough calls, maybe juggling payments, delaying things, it just seizes up the whole system. Which isn't good for anyone, least of all the business owner trying to, actually run the business.
Absolutely not. And good cash flow management isn't just about dodging those bullets. It's actually proactive. It lets you pay your bills comfortably on time.
Which builds good relationships with suppliers, I imagine.
It's huge. And it frees up resources, actual cash, to invest in growth opportunities when they arise. Plus, the reduction in stress. You can't put a price on that.
Yeah, being able to sleep at night knowing payroll is covered.
It lets you focus on the business, not just in the business, fighting fires. And look, the statistics are pretty sobering. There's a widely cited figure that's something like 82% of businesses that fail.
82%, wow.
Yeah, 82% cite cash flow problems as a major contributing factor. Not necessarily the only reason, but a huge piece of the puzzle.
It really drives it home. It's not just accounting jargon, it's survival. Okay, so let's tackle something fundamental then, because people hear profit all the time. Are you profitable? How is that different from having good cash flow? They sound related.
They are related, but they're definitely not the same thing. And this distinction is absolutely crucial. Profit is what you calculate, usually on your income statement.
Right, the classic formula. Revenue minus expenses equals profit.
Exactly. It tells you if, over a certain period, your business activities generated more value than they cost. On paper.
Okay, on paper being the key phrase there.
Precisely. Because, as folks like Berman and Knight point out in their work, that income statement often includes revenue you haven't received yet. Think sales made on credit, invoices sent out but not paid.
Ah, so you've earned it according to accounting rules, but the cash isn't actually in your bank account.
Correct. And similarly, it might include expenses you've incurred but haven't paid yet. So profit is an accounting measure of economic performance over time.
It's the theoretical result, the score for the period.
A good way to put it. Cash flow, on the other hand, is about the actual movement of money. It's tracked on the cash flow statement.
That statement people maybe don't look at as often.
Often, yes, but it shows exactly where cash came from, like customer payments, loans, and when payroll, rent, supplies, loan repayments. It's the real world liquidity.
So you could be showing a profit because you made a huge sale on credit.
Right.
But have negative cash flow because you had to pay suppliers for that sale and the customer hasn't paid you yet.
That happens all the time, especially in businesses with long payment cycles or big upfront costs. You can literally be profitable and bankrupt simultaneously if you run out of cash.
That's a scary thought.
It is. Understanding this difference is vital for making smart decisions. Can you afford that new equipment? Can you hire that person? Should you take on that big project? The profit number alone doesn't tell you if you have the cash to support it.
It really hits home why Mike Michaelovich, the Profit First guy, says that memorable line. Revenue is vanity, profit is sanity, and cash is king.
That quote just nails it, doesn't it? Revenue looks impressive, profit means you're fundamentally sound, but cash pays the bills today. It's the immediate fuel.
So, if cash is king, what are the common ways businesses, especially smaller ones, end up dethroning it? What causes these cash flow crunches?
Well, looking across the sources, several common culprits emerge again and again. Probably the single biggest one, the one mentioned most often, is issues with accounts receivable.
AR, that's the money customers owe you, right?
Exactly. Delays in collecting that money are just a killer for cash flow. You've delivered the product, you've done the service.
You've booked the revenue, you feel good.
But the cash isn't there. It's sitting in your customer's bank account, not yours.
Oh.
Every day it's delayed is a day you can't use that cash.
I can see how that sneaks up on you, especially if you're busy chasing the next deal.
It absolutely does. Another major issue is simply expenses being too high relative to the cash coming in. It sounds obvious, but...
But businesses grow expenses sometimes faster than revenue, or faster than collected revenue.
Precisely. You might be growing sales, but if your overheads, your marketing spend, your team costs are ballooning even faster, or if those sales have really long payment terms, you can run into trouble.
Sort of spending money you don't quite have yet.
In effect, yes. Then there's inventory management for businesses that hold stock.
Right, tying up cash in products sitting on a shelf.
Exactly. Too much inventory means cash is literally sitting there unproductive. But, as Ryan Daniel Moran points out, too little inventory can also be a disaster, especially for growing businesses. You get stockouts, lose sales, disappoint customers.
So that's a real balancing act.
It is. And finally, a really critical point that comes up is, frankly, just not paying attention, not monitoring cash flow regularly.
Flying blind, essentially.
Pretty much.
Yeah.
Ignoring it until suddenly you can't make payroll, and then it's panic mode. You need to be watching it consistently.
Mike Mikalovich talks about that expense issue too, doesn't he? That idea of trying to sell your way to success.
Yes, that's a great point he makes. Chasing top-line revenue growth without controlling costs or ensuring you can collect efficiently, you just end up doing more transactions that might actually drain cash in the short term.
And that connects to what Peter Drucker warned about, right? That even really promising, fast-growing companies can fail if they lack strong financial controls.
Absolutely. That growth itself consumes cash.
Yeah.
You need more inventory, maybe more staff, more materials before you get paid for the increased sales. If you're not managing the cash flow implications of that growth, you can literally grow yourself out of business.
Okay, so we've identified the villains. Slow collections, runaway expenses, inventory issues, just not watching the dials. How do we fight back? How do we actually improve cash flow? Let's dig into the strategies. Where do we start?
Well, logically, you start where the cash comes in. So managing accounts receivable effectively is almost always priority number one.
Getting paid faster.
Yeah. Getting paid faster and more predictably. It starts with having really clear payment terms up front. Don't be vague. And then crucially, having a consistent process for collections.
So this means actually asking for the money. Not being too polite or hesitant.
Definitely not too hesitant. It's your money, you've earned it. Proactivity is key. You need a system. Send invoices out immediately upon completing the work or shipping the product.
Not letting them sit on your desk for a week.
Absolutely not. There was a great example in one source. Just delaying sending an invoice by 10 days means you've lost 10 days of cash flow before the customer's payment term even begins.
Wow, okay. Simple but powerful. What about using software for this?
Hugely helpful. Good accounting software can automate sending invoices, track who owes what, and importantly, send out automated reminders when payments are due or overdue. Takes the manual effort and awkwardness out of it sometimes.
That makes sense. Automate the reminders. But what about those customers who are just consistently late? It's tough. You need the cash, but you don't want to torch the relationship.
That's the classic dilemma. It really is a balancing act. Some sources suggest having a clear, escalating process. You know, a friendly reminder first, then maybe a slightly firmer one, perhaps applying late fees if that's in your terms.
So it's not personal, it's just the process.
Exactly. And in set of cases, you might have to make the tough call to pause further work until they catch up. It depends on the client and the situation.
Are there other options if you're really in a bind because of late payments?
Yes, definitely. Options like invoice financing or factoring get mentioned. This is where you essentially sell your outstanding invoices to a third-party company.
Sell your invoices. How does that work?
They'll give you a percentage of the invoice value, say 80 or 90% immediately, upfront in cash. Then they take on the task of collecting the full amount from your customer.
So you get most of the cash right away, minus a fee or discount, and they handle the collection.
Exactly. It costs you a bit, but it turns those future receivables into immediate cash, which can be an absolute lifeline if you're facing a crunch. It helps bridge that gap.
Interesting. Okay, so getting paid faster is one side. What about the other side, the money going out? Controlling spending.
Equally vital. And this is where Mike Mikalovich's Profit First system offers a really paradigm-shifting approach.
The one where he flips the standard formula.
That's the one. Instead of the usual sales expenses, gross profit, he says it should be sales profit expenses.
Okay, my brain immediately wants to reject that. How can you take profit before you know your expenses?
I know, it feels backwards. But it's rooted in behavioral psychology. He talks about Parkinson's law.
Which is Work expands to fill the time available.
Right. Michael Levitz applies that to money. Expenses expand to consume the cash available. If all your revenue dumps into one big checking account,
You'll find ways to spend it.
you absolutely will. It's just human nature. So by taking your profit out, first physically moving it to a separate account, you intentionally shrink the amount of cash available for operating expenses.
Like his analogy of using smaller dinner plates to naturally eat less.
That's his go-to analogy, and it's perfect. You're forced to operate leaner, you have to become more innovative, more frugal, with a smaller amount of cash remaining for expenses.
So how does that work practically? Multiple bank accounts.
Yes, that's the core mechanism. He recommends setting up several specific accounts. One for income, where all revenue lands initially, one for profit, one for owner's compensation, one for taxes, and one for operating expenses, OPEX.
Okay.
Then, on a regular rhythm, say twice a month, you allocate the money from the income account to the other accounts based on predetermined percentages, your target percentages.
So you decide, say, 10% goes to profit, 15% to tax, 50% to owner's comp, and the remaining 25% is what you have for OPEX. Just throw numbers out.
Exactly like that, though the percentages will vary hugely by business. The key is that OPEX account now only has that specific allocated amount. That's what you have to run the business on.
And he even suggests putting the profit and tax accounts at a totally different bank.
He does. To remove the temptation, make it harder to just transfer money back into OPEX when things get tight. It forces discipline.
It's building a system that works with our psychology instead of fighting against it. That's clever.
It really is. It shifts the focus from how much can I spend to how can I operate effectively with this much.
Beyond that system, what other expense-cutting strategies come up?
More straightforward stuff too, of course. Things like systematically reviewing all your expenses. Look at subscriptions, are you using them all? Software licenses, services. Be ruthless. Cut what you don't truly need.
The stuff you signed up for and forgot about.
Happens all the time. Negotiating with vendors is another big one. Can you get better payment terms, a lower price, volume discounts? It doesn't hurt to ask.
Building those relationships again, maybe they'll work with you.
Often they will, especially if you're a good customer otherwise. There was even a more drastic suggestion mentioned.
Oh, yeah.
Reissuing company credit cards. This forces all automatic recurring payments to stop. Yeah, then you have to consciously go back and approve or re-enter payment details for everything. It's a shock to the system, but it forces awareness of every single automatic charge.
I would definitely make you think twice about every subscription. A bit extreme, maybe, but highlights the point about awareness.
It certainly does. And let's not forget inventory again, that balancing act we mentioned.
Right, managing stock levels so cash isn't just sitting there, but you also don't run out.
Exactly. Using forecasting, understanding lead times, maybe employing just-in-time principles where feasible. It's about optimizing that inventory turn, making sure it sells through efficiently.
And didn't Profit First also mention looking at clients?
Yes. Another potentially counterintuitive idea, evaluating your clients not just on the revenue they bring in, but on their profitability and how they impact your cash flow.
Meaning some clients might pay okay, but they take up tons of time, are demanding, or always pay late.
Precisely. They might look good on the revenue line, but they could actually be draining your resources and causing cash flow headaches. Mikhailovich suggests that sometimes strategically firing your worst, least profitable clients can actually improve your bottom line and free up cash and energy.
To focus on better clients, or find more profitable ones. That takes guts, turning away business.
It does, but it's about focusing on healthy, sustainable business, not just chasing any revenue. It requires a shift in mindset.
Okay, so we've got strategies for getting cash in faster, controlling what goes out, managing inventory, even choosing clients wisely. How does planning fit into all this? Budgeting and forecasting.
Planning is crucial for making all these strategies work together effectively. It's about being proactive, not reactive. Budgeting and cash forecasting are the main tools here.
What's the real difference between a budget and a cash forecast?
Generally, a budget is a longer-term plan, often for a full year. It translates your business goals like revenue targets, profit margins into specific financial numbers. How much do we plan to spend on marketing? What are our expected sales? It's the overall financial map.
Got it. The big picture plan for the year ahead.
Yes. A cash forecast is typically shorter term, maybe looking ahead week by week or month by month for the next quarter or so. It specifically projects the actual timing of cash inflows and outflows.
So when do we expect that big client payment to land? And when is that large supplier bill due?
Exactly. It focuses purely on the cash movement. When will we have enough cash? When might we face a shortfall?
Now, one source mentioned something interesting, that the budget numbers themselves are always estimates. They're never perfectly right. So why bother if they're wrong?
That's a great question. The value isn't necessarily in hitting the numbers exactly. It's in the process of creating the budget and the forecast.
The process itself.
How?
So,
Because it forces you to think critically about your business drivers. What assumptions are you making about sales? Are your expense estimates realistic? It forces you to look ahead.
and it gives you a baseline to compare against reality as it unfolds.
Precisely. It acts as an early warning system. If actual sales are consistently below budget or expenses are creeping up higher than planned, you see it early. You don't wait until the bank account is empty.
You can make adjustments, maybe cut costs sooner or push harder on collections or rethink a planned expenditure.
Exactly. It allows for course correction before you hit a crisis. That foresight is incredibly valuable. Creating one involves looking at past performance, using some budgeting tools or templates, and having honest conversations about your plans and the market.
So it's about anticipating, not just reacting. Makes sense. We touched on some tools already, accounting software, maybe those multiple bank accounts for the Profit First system. Anything else specifically mentioned for helping with cash flow?
Yeah, beyond the general accounting packages, which are fundamental for tracking everything, some sources specifically mention dedicated accounts receivable AR management software.
Software just for chasing payments.
Pretty much. It automates a lot of that follow-up sending reminders tailored to how overdue an invoice is, providing online payment portals for customers, tracking communication. It streamlines that whole crucial collections process.
Okay, so that could be a worthwhile investment if collecting is a major bottleneck.
It certainly could be. While things like AI for super accurate forecasting might be on the horizon, the core tools discussed for day-to-day practical management right now are really robust accounting software for visibility, and potentially these specialized AR tools combined with discipline systems like the Profit First banking structure. The key is using tools that provide clarity and enable action.
Right, tools that help you see what's happening and stick to your plan.
You got it. It's about having the information and the structure to make good decisions.
So pulling all these threads together, managing cash flow effectively isn't really about one single trick, is it?
No, not at all. It's a combination plate. It's about speeding up the money coming in through better invoicing and collections.
Yep.
It's about rigorously controlling the money going out through careful budgeting, expense management, maybe using a system like Profit First.
Makes sense.
It's about managing inventory smartly, if that applies to you. It's about planning ahead with those budgets and forecasts so you see bumps in the road before you hit them.
And using the right tools to make it all easier to track.
Exactly. And maybe the most important piece woven through all of this is consistent monitoring.
Not just looking when there's a problem.
Absolutely. The sources really emphasize making cash flow review a regular, routine part of managing your business weekly, maybe even daily, depending on your business cycle, not just a panic drill.
Because small adjustments made consistently can add up.
Hugely. Improving your collection time by just a few days or cutting a seemingly small recurring expense. These things compound. They free up cash that can be used productively. It reinforces that Drucker idea. Again, financial discipline is the foundation, especially when things are moving fast. Neglect it, and even a great business idea can crumble.
It sounds like it really comes down to building financial discipline, building those healthy habits. Like you said about Profit First, maybe starting with small percentage allocations and gradually increasing them. It's a journey, not a switch you flip overnight.
That's a perfect way to describe it. It's about building financial muscle over time. And honestly, getting control over this aspect dramatically reduces stress and empowers you as a leader.
You're steering the ship with a clear view of the fuel gauge, not just hoping for the best.
Couldn't have said it better myself. It allows you to operate from a position of strength and opportunity.
Some really powerful practical insights there. Definitely a lot for business owners to think about and, more importantly, act on.
So here's a final thought to chew on. If revenue can be vanity, if profit isn't the whole story for survival, and if unchecked growth can actually sink you, what is the single most crucial indicator you should be obsessing over to gauge the genuine day-to-day health and the long-term sustainability of your business?
Something to definitely mull over as you take a hard look at your own numbers after this deep dive. Hey, if you found value in this deep dive but haven't subscribed yet, why wait? Every subscriber fuels this show to keep delivering the real game-changing content you need. Hit like, drop a comment, and subscribe. And NOW, don't miss out on the next deep dive that could change everything for you.